Hello, welcome to the Deep Dive. Today we're actually taking our 35th deep dive into the wisdom of legendary investor Peter Lynch. Now, we often get fantastic questions from you, our listeners, and today's is a classic one. Someone asks, bad news makes stocks fall and good news makes stocks rise. How do you determine whether news is good or bad? These days, there's so much information on YouTube as well as on the news. What criteria should we use to filter it? That's a brilliant question, really, especially if you're, just starting out in the U.S. stock market and trying to make sense of, well, just the flood of information out there. So our mission today is to give you a clearer lens, maybe some practical tools to interpret news as an investor, and help you filter out some of that noise.
That's right. And it's a common starting point, that idea that, positive news always means the stock goes up, negative news means it goes down. It sounds logical. But the reality of how stock markets move is, well, it's far more nuanced than that. There are definitely deeper layers at play. And understanding them is absolutely essential for anyone looking to make informed investment decisions.
I appreciate you putting it that way because it feels like such a fundamental rule, doesn't it? You see a headline like, Company A posted a profit of $1 billion this quarter, 10% more than expected. And your first thought is, naturally, okay, the stock's going up. But then sometimes, maybe the next day, the stock actually drops 5%. How does that happen? Like, where's the disconnect there?
Yeah, it is really counterintuitive at first glance, but there are a few core reasons for this whole good news, bad stock reaction thing. The first one really revolves entirely around expectations. The stock market is always looking forward. It prices in what investors think is going to happen. We sometimes call this the "this much is a given" principle. So if analysts and the big investors had already expected even better results, let's say they were hoping for 15% profit growth from Company A, then that 10% increase, while positive in absolute terms, is seen as, well, a relative disappointment. And when those high expectations aren't met, even just slightly, you can see investors starting to sell. And that pushes the price down.
Okay. So it's not just about the actual numbers, but what people thought the numbers were going to be beforehand. Kind of like getting an A on a test when everyone, including you, was banking on a solid A. Still good, but maybe not the amazing result hoped for.
Exactly that. A perfect analogy. And we saw a sort of example with Tesla Inc. back in April 2024. They announced Q1 results that were actually better than the market's pretty pessimistic forecasts at the time. They even moved up plans for cheaper models. Sounds good.
Right.
Yeah.
Well, positive.
Yet the stock price stayed really volatile. Why? Because these bigger picture concerns, things like a general slowdown in EV demand, intense competition, those just overshadowed the, hey, we beat earnings estimates news. The market was already worried about those bigger future problems.
That distinction is so important. It's not just the past quarter, but what everyone thinks is coming next.
Precisely. And that brings us neatly to the second reason, anxiety about the future. Investing, fundamentally, is all about the future, not just looking backwards at past performance. Companies often give what's called guidance. That's their own forecast about how they expect to perform in the coming quarters or even years. So a company might announce fantastic current results, really great numbers, but if that news comes with a warning about lower future profits, maybe because raw material costs are going up, or maybe new competition is eating into their market share, investors often react much more strongly to that future uncertainty. They'll start selling, anticipating a potential downturn rather than celebrating what just happened.
Okay, that makes sense. So even if Apple, say, announces amazing iPhone sales for this quarter, way past expectations, if they then hint that their growth rate might slow down next quarter, the stock could fall because that future outlook just weighs heavier.
That's a perfect illustration. The future always casts this long shadow over the present in the market. And the third reason is something you'll often hear tossed around. Sell on the news. Stock prices often climb, sometimes significantly, in anticipation of big news. Think about the hype leading up to a potential new tech breakthrough, or maybe a crucial drug getting approved. All the rumors, the speculation, the excitement that can drive the stock price up for weeks or months before the official announcement hits. Then, once that highly anticipated news is finally out, a lot of investors who got in early decide, okay, time to lock in profits. They sell their shares. And this wave of selling can actually cause the price to drop, even if the news itself was positive and exactly what everyone was expecting.
Gotcha. So the good news was essentially baked into the price already, maybe months ago. The announcement just becomes the trigger for people to cash out. That really clears things up. Okay, so if we can't just rely on simple good or bad labels for headlines, what's the practical way for us as investors to actually judge the news?
Right. This is where critical thinking becomes your best friend. Before you jump to label news as good or bad, you really need to pause and ask yourself a few key questions. Think of it like your personal news analysis checklist. First up, what were the market's expectations? What were people generally anticipating before this news dropped?
Okay, expectations first. And then second, looking beyond just the headline. What's the real impact of this news on the company's future? Is this genuinely positive or negative for their long-term growth, their ability to innovate, make profits down the line?
Exactly. Third, you have to think about timing and the current price. Isn't this already reflected in the stock price? Has the stock already shot up recently precisely because people were expecting this news? And finally, this one's crucial for digging deeper. Is there any hidden context? Are there important details lurking behind the main headline that aren't immediately obvious? Like, did the company take on a ton of new debt to get that profit number? Or did a really key executive suddenly leave? Using this checklist forces you to look beyond that surface level.
That checklist sounds incredibly useful. And it actually ties in beautifully with some core wisdom from Peter Lynch himself. He had quite a bit to say about how investors should handle news, especially when it came to what he called weekend panic.
Ah, yes, Peter Lynch. He famously said, "Worrying about the market on the weekend is one of the surest ways to lose money." He really believed that trying to predict short-term market swings, particularly reacting to news that comes out after the market closes on Friday or over the weekend, well, it's often pointless and can actually hurt your returns. He called it weekend panic because it leads to these irrational decisions come Monday morning.
Yeah, and his analogy for this is just brilliant. He said, a decline in the stock market is as predictable and natural as a blizzard in Minnesota in January. You should be prepared for it, but you shouldn't run out of the house in terror because of it.
It's such a powerful, timeless message, isn't it? He stressed that investors often lose way more money trying to predict and avoid market declines than they actually lose from the declines themselves. The core message is really this. Don't let the short-term market noise, the daily headlines, completely derail your long-term investment plan. Just because some piece of bad news breaks over the weekend doesn't mean the fundamental value of a great company you own has suddenly evaporated. Panic selling on Monday morning, just dumping shares out of fear. That's often where the real money is lost.
So Peter Lynch's advice here is really clear. Pay attention to news, yes, but don't get totally swept up in the noise. The news that truly matters is the stuff that affects a company's long-term fundamentals, its actual business, its products, its future prospects, most of the daily wiggles. Just noise. He also always told us to invest in what we know and understand. If you really get a company's business model, its products, you'll have more conviction for the long haul. You won't be so easily shaken by every little news blip. And ultimately, his advice was always, find great companies and hold on to them. When the stock price of a fundamentally solid company takes a temporary hit because of some short-term bad news, Peter Lynch often saw that not as a reason to panic sell, but maybe even as an opportunity to buy more shares at a better price.
That leads us perfectly into how you can actually cultivate this kind of, let's call it Lynchian skepticism, and train your own mental muscles for this kind of critical news analysis. It really is a skill, and like any muscle, it gets stronger the more you practice it.
Okay, so what's the training routine then? How do we build up this investor's mindset?
Well, the very first step is a fundamental mindset shift. You need to aim to be a detective, not a sponge. A sponge just soaks up news passively. Headline says, Company A in crisis. The sponge thinks, uh-oh, Company A is doomed. Simple as that. A detective, though, treats every news item like a clue. Sees that same headline and immediately starts asking questions. Okay, is it really a crisis? Who's reporting this? What might their angle be? What other facts or clues should I be looking for? Starting today, really try to approach all news like a detective and always ask why, at least 3 times.
That mindset shift alone feels huge, just changing how you approach information.
Yeah.
So how do we put that detective mode into practice, like on a regular basis?
You can start small, maybe just 15 minutes a day, focusing on 2 simple exercises. Exercise 1, see the same news from different perspectives. Pick one big topic, let's say Apple's launching a new iPhone, and make a point to read articles about it from at least 3 different types of sources. Maybe check a major business outlet like the Wall Street Journal or Bloomberg. They'll likely focus on the money side market share, stock impact, financials. Then find an IT specialty site, maybe The Verge or TechCrunch. They'll dig into the tech specs, the innovation, the user experience. And finally, look at a general news source like AP or Reuters. They often cover the broader impact, consumer reactions, aiming for a more balanced overview.
Okay, and while reading these different takes, what should we be looking for specifically? What's the goal?
As you compare them, ask yourself, how are the headlines different? Does one scream innovation while another highlights price concerns? How do the experts they quote differ? Do they even contradict each other sometimes? This exercise really quickly shows you that there's rarely one single objective news story. Every source brings its own perspective, its own emphasis.
That's a really valuable insight. Okay, what's the second exercise?
Exercise 2 is about deconstructing facts and opinions beyond the headline. Grab any article you're reading and maybe use 2 different highlighters or just make mental notes. One color for objective facts, things you can verify, numbers, dates, like Company A's second quarter revenue was $5 billion, a 5% increase year over year. That's a verifiable figure. Then use the other color for subjective opinions or interpretations. Stuff like, Company A's disappointing growth will make investors anxious. See how words like disappointing and phrases like will make anxious are clearly the writer's judgment call, not a hard fact.
Right, so you're training yourself to pull apart what actually happened from what someone thinks or feels about what happened.
Exactly that. Ask yourself, is this article mainly trying to give me facts, or is it trying to persuade me with an opinion? Are there opinions dressed up to look like facts, or facts used selectively to push an opinion? Doing this regularly really sharpens your ability to get to the core facts without getting swayed by emotional language or loaded adjectives.
Makes sense.
Yeah.
And what's the third step in this mental workout routine for investors?
Step 3. Create your own investment notebook. This one might be the most powerful tool for building that rational, contrarian muscle. Keep a simple log, maybe in a notebook or just a spreadsheet. Have columns for date, company news, my initial thought, your gut reaction, your emotion, analysis, the facts you gathered, the questions you asked using your checklist, my conclusion. So was this really good or bad long term? And then this is key, a column to check the result after, say, 3 months. So for instance, maybe on July 12th, 2025, you see news about Netflix. Subscriber count up 10% more than expected. Your initial thought might be, wow, awesome, stock's going to soar. You write that down.
Okay, capture the emotion, but then you deploy the detective skills for the analysis part.
Exactly. You note the facts. Subs up 10%. Then you ask those deeper questions. What happened to average revenue per user, ARPU? Did content costs also jump? What are competitors doing? Your conclusion, after thinking it through, might become, short-term positive, sure, but rising costs are a big question mark. Let's call it neutral positive. Then, 3 months later, you look back and record the result. Okay, stock popped initially, then kind of went sideways as those cost concerns really came to focus.
Wow, that notebook sounds incredibly revealing. It really forces you to confront your own thinking patterns.
It's genuinely transformative if you stick with it. Doing this consistently brings huge benefits. First, you start to see your own biases clearly. What kind of news gets you overly excited? What analytical shortcuts do you tend to take? Second, you learn directly by comparing your analysis to what actually happened. Your skills improve massively when you see why you were right or wrong. And third, maybe most importantly, it actively combats emotional investing. The act of writing things down, your reaction, the facts, your questions, forces you to slow down, dampens that initial fear, agreed, and pushes you toward a more rational judgment. And honestly, these aren't just investing skills, they're life skills. They help you understand the world better, avoid being misled, and just make smarter decisions all around.
That's a massive takeaway. Okay, let's shift gears slightly and tackle a very modern challenge: stock YouTubers. A lot of people, especially when they're new to investing, get a ton of their news and analysis from YouTube channels. And while they can make things seem quick and easy to understand, there's always that risk of bias, or maybe even someone trying to mislead you. How can we possibly filter through all that content to find the reliable stuff?
Yeah, that's a critical question for today, absolutely. Stock YouTubers have certainly made information more accessible, which is great in some ways. But you're right, it can also be a total minefield. Learning to tell the difference between a genuinely helpful expert and someone just pushing an agenda or chasing clicks, that's a vital survival skill for any investor now. So let's outline a kind of YouTuber credibility checklist to help you approach this content with a much more critical eye.
Perfect. A checklist sounds exactly like what listeners need. What's the first thing to look for?
First, think about what are they saying. This is all about the actual substance, the depth of their content. A really big warning sign, X, is if they mainly just try to stir up your emotions. Channels that use extreme language, you'll regret it for the rest of your life if you don't buy this stock now, or go all in right away, or the classic, a crash is imminent, sell everything.
Yeah.
You should be immediately suspicious. Their main goal might just be to cloud your judgment and push you into acting impulsively.
Right, wary of the hype merchants.
You're
So what's a positive sign then?
A positive sign is if they consistently explain the why behind their statements. Instead of just saying, stock A is great, a trustworthy channel will offer evidence and logic. They might say something like, stock A looks interesting because of these financial metrics, and its new technology B could give it an edge in market C. However, you also need to be aware of risk D. They give you the reasoning, and they acknowledge downsides. Another really good sign. Do they talk about both the positives and the negatives? Every single investment, every company has pluses and minuses. Someone who only ever lists the good points and confidently says this is definitely going up. Highly suspect. A real expert discusses potential risks, the disadvantages, maybe even mentions counter-arguments. They offer balance.
That balanced view definitely builds more trust. Okay, what's the next point on our YouTuber checklist?
The second point is, how do they say it? This gets into their attitude, their transparency. A major warning sign X is if they never admit when they're wrong. A genuinely trustworthy YouTuber will sometimes say, okay, I got that prediction wrong last quarter, and here's why I think my analysis missed the mark. Be very cautious of channels that seem to quietly delete or just ignore their bad calls and only ever brag about their winners. Another big red flag X, are they constantly pushing you to join some paid group or buy a specific course or product? If the content feels more like a sales pitch, especially using that fear-based language like, the really detailed crucial info is only in my exclusive paid room, while their main aim might be business, not actually educating you freely.
Yeah, looking for genuine transparency and integrity, not just slick marketing. What's a positive sign here?
Exactly. A strong positive sign is when they clearly and consistently tell you where their information comes from. A YouTuber who says, according to this Bloomberg article from last Tuesday, or if you look at page 35 of the company's latest 10K earnings report, that shows responsibility. It shows they're accountable, and crucially, it empowers you to go and check the facts for yourself. That's absolutely vital if you want to become an independent thinker, an independent investor.
That's incredibly helpful for navigating this landscape. Okay, so let's say we've used the checklist, found some potentially credible YouTubers. What's the final step? How do we use this info to become truly independent investors?
Right, because even with a really good YouTuber, you should never just blindly follow their advice. Think of them as providing ingredients for thought, maybe some interesting ideas, but you have to be the chef. You're the one making the final decision, preparing the actual meal, your investment choice. So first, always practice cross-checking. If one YouTuber you trust recommends a stock, make it a habit to actively look for another reputable source, maybe even someone with an opposite view, just to get a more rounded picture. Second, and this is so important, check the primary source. Get in the habit of going directly to the original source material they mentioned in the news article, the company press release, the actual financial report, like the 10K or 10Q. Information can easily get twisted or maybe only partially presented in a quick video summary. Go see the original. And third, this is maybe the most empowering step. Set your own investment principles. Decide on your own clear personal rules for investing. For example, you might decide, I'm only going to invest in companies with a PE ratio under 20 and a debt-to-equity ratio below 50%, whatever your rules are. Having these firm principles gives you the confidence, the courage to just ignore a recommendation, no matter how hyped it is, if it doesn't fit your specific plan. That's a really powerful framework. So it's not about being told what to buy. It's about using these resources as like inputs into our own independent decision-making process.
Absolutely. Think of stock YouTubers or really any financial news source as just one of your reference books. They are not the teacher who dictates the answers. The real process of becoming a wise investor is about comparing different reference books, critically checking the important details in the textbook, the original source material, and then finally, creating your own unique solution, your informed investment decision. If you consistently practice this kind of critical filtering, you really will develop the skill to sort the true gems from all the noise, all the stones, in that relentless flood of information we all face. That is just fantastic advice, truly applicable, like you said, not just for investing, but for understanding the world around us in general. And, today's Peter Lynch quote really encapsulates so much of what we've talked about. Your guts are your biggest asset. This principle, as we've explored, isn't just about blind feeling. It's connected to trusting your disciplined analysis, your well-researched conviction, trusting your gut after you've done the hard work, rather than reacting emotionally to every headline. It's about that blend of analysis and conviction, which is really life wisdom, too. We hope this deep dive has been helpful. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a great day.